It's 8:35, a little bit over our time. Welcome to the 35th USAE IAE North American Conference. My name is Sri Vikas. I'm your 2017 USA President. I work at ConocoPhillips as Director of Market Intelligence and Business Analysis. And many thanks for your participation in the conference. Your participation in USAE gives us ability to offer a neutral platform for discussion, dialogue, and deliberations for all types of energy resources. So many thanks for your participation. Let me introduce the head table here. To my immediate right is Ricardo Ranieri. Ricardo is President of International Association for Energy Economics, IAEE. As many of you already know, IAEE is the global organization for business, government, and academic professionals concerned with energy and related issues on a global basis. And the USAE is the largest country affiliate of IAEE. Sitting just right to him is Tomas Drennen, our VP for conferences. He has worked really hard and tirelessly on many aspects of conference to make this conference a quite successful conference. So as you know, the conference theme is riding the energy cycles. So it's so apt, given the status of the industry today, that what we have. We have seen extreme volatility in energy markets in the past, and hopefully this conference will give you insights into energy market direction and volatility through vigorous discussions on economics, policy, technology, and financial drivers driving the markets. In order to facilitate such a discussion, we have dedicated sessions on many related topics, such as geopolitics of oil and gas markets, energy finance, energy entrepreneurship, upstream oil sector adaptation strategies, renewable energy integration, electric system flexibility, intelligent energy systems, etc. And at the end on Wednesday, we will sum it all up, whether we are cycling uphill or downhill, and where do we go from here. That's going to be a great session on Wednesday. And I'm positive that this conference will give you a good venue for educational and networking opportunities, as it has done in the past. But I also hope that the conference will provide you with practical tools to really help develop insights into how the energy markets are surviving, adapting, and evolving. And hopefully will give you insights on how to do business better going forward. It takes a lot of time, volunteering, planning, and resources to put together a successful conference like this. The last count, I talked to Dave Williams. We have over 300 registered delegates, a great number given the current industry environment we have, and about 90 first-time attendees for this conference. And this conference could not be possible without support of many, whom I would like to now offer thanks on behalf of the USAE, the individuals and sponsors who have made this conference quite successful. First of all, thanks to Tomas Drennen as plenary session chair. We have a total of 10 plenary sessions planned for you. To Peter Hartley, who worked meticulously to put all technical papers in a total of 36 concurrent sessions that we have. Thanks to John Holding as posters session chair, Parth Vaishnav for case competition, Caldwell Bailey for setting up the technical tours, the offshore drilling rig museum, and also the Petronova power generation and carbon capture facility, which is sold out. Andrew Slaughter for heading the sponsorship committee. Melanie Craxton as student program coordinator. You can find names of all the committee members who helped organize the conference in the final program guide. Thanks are also due to all the sponsors without whom we would not be able to afford this conference. They are in the alphabetical order as follows: Benjamin Schlesinger and Associates, Robert Borgstrom, Chevron, ConocoPhillips, Deloitte, EPRI, Endes, ExxonMobil, John Holding, NETL, NREL, OPEC Fund, Resolve Energy, Rice University Institute. I'll repeat that: Rice University Baker Institute, Shell, and Alfred P. Sloan Foundation. Let's have a round of applause for all of them. Great. A few more points. We had a PhD day and case competition yesterday. Many thanks for attending them. They were very well attended. And also, I would like to thank the mentors and students for attending the student breakfast session and mentoring today in the morning. Also, thanks to Kim Kaufman and Fletcher Fields for continuing to organize the government track, which we started last year. And the government track this year is titled Electricity System Flexibility, scheduled for tomorrow, 2 p.m., Tuesday. Thanks, Kim, for that. We will have short formal remarks by Ricardo, followed by Tom. And after both their remarks, I'll come back and I'll do something different this year. We have put together, with the help of business committee, a poll everywhere software, and we would do 2 live polls in the audience today itself to really get a pulse of the delegates as to where the industry is, etc. So we'll conduct the survey live here and review results together right here. And I hope you find that interesting and a little different. You will need your cell phones for that, and the Wi-Fi passcode was given to you. So just wait for that. I'll come back for that session later. So before I invite Ricardo for making formal remarks, let me introduce him. As I mentioned earlier, Ricardo is 2017 IAEE president, and he is an energy professional with a multitude of skills. He is an economist, academic, researcher, consultant, and also in part of the political party. So you can say he's a politician as well. He's actually going back to Chile. There's elections going on later this week. In 2010, Chile's President Sebastián Piñera nominated him to the Ministry of Energy. He's also the chairman of the Chilean state oil company ENAP, and former chairman of the board of ENAP, and also former alternative executive director of the World Bank. He's also a board member of Schwager Mining and Energy Company. Ricardo, floor is yours. Thanks.
Thank you, Tri, for your words. Well, I want to thank you all for being here, for the International Association for Energy Economics. It's a great pleasure to organize with the USA Association for Energy Economics this 35th USA IAEA North American Conference, Riding the Energy Cycles. I want to thank the organizers, the USAE, and the Houston chapter of the International Association for Energy Economics, all the people that was involved in the organization of the conference, as Chiribikas, Tomas Drennen, Peter Hadley, John Holding, Part Vachnab, Caldwell Bailey, Andrew Slaughter, Melanie Craxton, the USAE, the Houston Council, and a long list of people that took place in the program committees for the organization of this event. Also, from IAE, we want to thank strongly our sponsors, because without the support of the sponsors, these events in general will be very difficult, very complex to be organized, so their contribution to organization of these events are very important. So I want to thank also all of them. We're in 2017, nice year, and if we go back 40 years ago, was the time when the International Association for Energy Economics was founded by a group of visionary energy economists. If we look back the history, if you start doing some research, you get into internet, you will find that the first seats of the International Association for Energy Economics appears in the Allied Social Science Association meeting that took place in December 1977 in New York. So also we want to thank and recognize our founding fathers. I have one of them here, Mr. Jim Plummer. And I think that their contribution, their vision to the founding of this association has been very important. It's an association that starts very small here in the US, in Cambridge in UK, and today it has grown a lot. When we look back, the association was born at the time when Apple Computer was founded. Also was the time when we have the first flight of the Concorde airplane between London and New York, but also was a time with interesting energy development. We have the big blackout in New York City that lasts for about 25 hours. 9 months later, the birth rate went up. And we have to regret the loss of Elvis Presley, who died at the age of 42. The association was born in a time of very complex situations going on around the energy sector. It was born immediately after the first oil crisis in 1973-74, and just before the Iranian crisis, when they cut production and export to Western countries. From 1977 up to today, the world has changed a lot. In 1977, we were 4.2 billion people. Today, we are 7.5. The world economy, for good, has increased a lot. If you look at the size of the world economy, it has increased by more than 200%. And at the same time, we have that primary energy consumption has increased or more than doubled with respect to 1977. However, we still have some things in our do list. We still have about 1.2 billion people in the world without access to electricity, and 2.7 billion people without access to modern cooking facilities. Today, we are living in a world with increasing CO2 constraints. So the issue of climate change is becoming a main part of the discussion of the energy sector. And if we look forward, we expect that energy consumption will increase about 40% between today and 2040. Most of that increase in energy consumption will take place in developing countries. And what we have seen in the last years, what is a good part, I think, is that innovation has become a key driver of change in the energy sector. And without the big innovation we have seen in the last few years, certainly we'll be in a big trouble trying to satisfy the energy needs that have been growing for the last 40 years. What is IEE today? The International Association for Energy Economics, since its beginning 40 years ago, today is an international association with 4,100 members. It's present in more than 90 countries. It has a diverse membership in terms of their professional background. Initially, it was founded as the International Association for Energy Economists, and it changed the name to International Association for Energy Economics that is not only an economics association, so we invite everybody with interest in energy and economics to be part of this great association. We have 3 leading publications: the Energy Journal, that is, I would say, the most important journal in the field of energy economics. It was initiated back in 1980. We have a much newer publication, a wonderful one, that is the Economics of Energy and Environmental Policy, that started in 2012. And we have, since 1978, our newsletter that initially was called IEE newsletter, and today is known as the Energy Forum. Every year, the association organizes one international conference and many regional or local chapter conference, as the U.S. meeting that we have today. And in the last year, the association has been working hard to enlarge its footprint in regions where we see that as association we have only some few members. And we put as a target to increase our presence in regions such as Africa, Eurasia, Asia, Eastern European countries. And in the last year, we have already hosted events, conference in Azerbaijan, Croatia, South Africa, Bangladesh, and certainly we are looking next year to host some events maybe in Senegal, Cote d'Ivoire, Vietnam, among other countries. So we want to bring a lot of people with a very diverse background, cultural backgrounds to this association. And we want to keep going on that. What about the relation between IEE and USAE? Yesterday we have a wonderful meeting of the USAE Council. I was lucky to be invited there to give an upgrade of what we are doing in the International Association for Energy Economics. And I want to say that the relation, even though USAE and IEE are 2 separate associations, the relation between both of them is very important. For IEE, it's very important, the relation with USAE. Both are incorporated in the US, even though the USAE is a 100% US association. The International Association for Energy Economics is a global association, but it's incorporated in the District of Columbia. So we are under the laws of the District of Columbia. So it's very important to have this backbone of the US association in terms of the relation that we have with the International Association, because in general, I would say that the history, most of the knowledge of what is going on in the International Association is very strong link with the USA Association for Energy Economics, and we were talking about ways how we can improve this relation between both associations, keeping the independency of each of them, and I think that is very important for the success of USAE and also for the successes of IAE. So just to finalize, I want to invite you to save the dates in your agendas for upcoming events. Next year, the 41st International Association for Energy Economic Conference will take place in Groningen in the Netherlands. That will happen in June. In August, we are going to have the 16th IE European meeting that will take place in Slovenia. In September, you must know that we are going to have the next meeting of the North American Conference that will take place in Washington, D.C. For the 42nd International Conference of the International Association, it will take place in 2019 in Canada. For those that like lights, you should prepare for Paris to 2020. That will take place the 43rd International Conference Association. And for 2021, we are going to have the 44th IAE International Conference that will take place in Tokyo. Okay, so we have already planned up to 2021 the International Conference of IAE. So you are invited to put that in your agenda and to plan to be there. So thank you for being here, and I want to congratulate the organizer for this wonderful event. And I want to leave with you our next speaker here, Tomas Drennen. Tomas is a very old friend of the association. He has a long career as professor, but also at Sandia National Labs. He was there for more than 20 years, recently retired, and still is working. And he is a professor of the William Smith College, and he is a very well-known person in terms of energy, environmental economics, and models of climate change. So thank you for being here.
Uh-oh, I've reached the ranks of a very old friend. Uh-oh. So I guess I've been coming to this conference for, seems like forever. And it's the one conference I come to every year. And when people ask me why, I say, because where else are you going to find a conference where you have a really good mix of industry, academics, and government folks? And so that's one of the things I personally value about this association. The different viewpoints that you'll hear at the conference. I think it's really valuable. Okay, we do have a photographer roaming around on behalf of USAEE taking some pictures. Just wanted to let you know, already kind of obvious, I think. They will be showing up in concurrent sessions as well. I have a couple other announcements to make before we get on with the fun part of the morning. So first, there's still seats in the Energy Risk Management Workshop for Wednesday afternoon. So if you're interested in doing that, please go to the registration office and sign up for that. I want to highlight today's lunchtime keynote speaker. We have Robert McNally, founder and president of the Rapidan Group. And also the author of a 2017 book titled Crude Volatility, The History and the Future of the Boom-Bust Oil Prices. And it seemed like, when the program committee got together to do this, it seemed like a perfect topic to tie it all together. And so at lunch today, he will be speaking. His talk is Welcome Back to Boom-Bust Prices. I really want to thank all the committee members who've worked so hard on this. We know that the title, the general theme of the conference is Riding the Energy Cycles, and the whole process started a year ago at the Tulsa conference where we got together on Wednesday morning, and we'll do that again this year. Wednesday morning at 7:30. If you want to talk about next year's conference in DC, come join us. We came up with this long list of what people would like to see in plenary sessions. Probably had about 30 ideas. And then we started meeting shortly after that on a regular basis. And throughout the year, we narrowed it down, found all the moderators, the speakers for these sessions. And again, I just want to focus attention on the fact that what we try to do is we're mindful of the overall topic and how they all fit together. We really wanted to provide a good balance. So, we're talking obviously about oil, natural gas, refining, also bringing in renewables and storage, new ideas in financing. So several of those themes that all are really related to where we are with the volatility and the current prices in energy markets. All right, so I do want to thank the presiders now in advance, the presiders of the 10 sessions. Thank you for agreeing to do this and keeping everything on schedule. The 10 presiders are Ed Morse, Martha Goodall, Tina Vital, Alejandra Elizondo, William Starnes, Sri Vikas, Alberto Lamadrid, Chiara Loprete, Caldwell Bailey, Melanie Craxton, and David Knapp. Thank you for your roles in this. The entire list of the program committee is in your conference program. Everybody, I hope if anybody was left off, it's my fault and I apologize. Thank you all for all your hard work. And again, If you want to be involved in next year's conference planning, come on Wednesday morning, 7:30, throw out your ideas, get involved, and that's how it all happens. Finally, up here you'll see throughout the conference the link to the survey. The survey is really important to those who are organizing the conference. We will review those, we'll talk about them, we'll compile it in many different ways and try to figure out what the key points are, but we do spend a lot of time talking about it, so it's really important that you take just a few minutes and tell us what you think as the conference goes on, hopefully near the end of it, so you will have gained the whole experience. But the URL will be up there throughout the conference, and I think that's all I'm supposed to cover. Yes, it is. Thank you very much. On with Shri is going to come back and introduce and get us and kick us off. Thank you very much.
All right, thanks, Ricardo and Tom. As I mentioned earlier, before I close the welcome session and invite the panelists for our opening plenary, let's see what's in the pulse among delegates about the energy market. So let's hope it works. Let me open the poll questions. So the way it's going to work is I would have 2 poll questions, and the instructions are on the slide here. You either go to pollev.com right now and /USAEE17, or you can text to 22333 and then enter USAE 17 to join the poll question. And then you will have these 5 options. Now, the question that we have put together, as you know, as I mentioned, we have about 300 delegates. They represent quite a diverse set of job affiliation, industry segment, geographies, and energy resources. So it will be very interesting to see how the overall polling comes along. We already know that the energy markets have experienced extreme volatility. So this question basically tries to get your pulse on what will cause the most oil market volatility going forward in the next 5 years. And what I have done is I have taken out oil price from the equation completely. So there's no question, there's no one of the options is oil prices. So if you don't have oil price as your driver for oil market volatility, what could the other factors be which are equally important? And there may be many reasons for that, but if you have to really pick one, what would you pick? So get your browser up and see. I'm going to go on the next screen, and I'm already seeing votes coming in. Let me poll myself. Poll EV. All right. So it looks like it's about still votes are coming in. OPEC decisions and supply disruptions from conflicts. That's pretty high up. All right. So I think, yeah, still on global economic growth, 14%. Transport technology, that's basically significant change in transportation, the way we are moving around, electric cars, etc. The third one, which is 17% now, is significant change in shale technologies and production. And rock solid is 58%, is OPEC decisions and our supply disruptions from conflict. So I think good answer. I think and nobody thinks about service industry cost inflation. So thanks a lot for that. All right, let's move to the next one. All right, so the way we set this question up is over the next 5 years, everybody would like to work in one segment versus another. We have professionals here working in all different sectors and resource types. And the way this question is set up is, which energy segment you believe is going to see the most employment growth? Where would you see a lot of jobs would be created? And again, there could be many factors, but if you have to pick one, and if you believe, what would that be? Put your question up. Same kind of setup here. Go to pollev.com/USAE17 or text. 5 options. First is whether there would be most employment growth in shales and working in shale resources, midstream petrochemicals, renewables, the solar, wind, etc., power markets and trading, or energy investing and finance. So let's look at the responses. No surprise so far, it appears. Renewables, growth, we are talking about growth percentage here, so working from a small base, the growth would be much higher. Still shows renewables, solar and wind. Second is the US shales, midstream and petrochemicals, 10%, and it keeps going up or down. Let me vote myself. All right, still coming in. Looks like renewables, solar, wind, clean tech, those kind of sectors, that's where the delegates feel the maximum growth would be. Great, thanks, great results. I did anticipate some of them, so hopefully it was interesting for all of you. Doing this, we would have this kind of a poll everywhere in a few other sessions as well. All right, this concludes the welcome session. Please don't go anywhere as our plenary session is starting now. I would invite Ed Morse, who will preside the session with Sarah, Ladislaw, and Amy Meyer-Jaffe. Thank you. Yeah.
So welcome to this opening session, everyone. It's a pleasure for me to be on this panel with 2 very good and long-term friends, Sarah Ladislaw and Amy Jaffe, each of whom is responsible for energy studies, including environmental issues and security issues at 2 of the most prestigious establishments in the country, the CSIS in Washington, where Sarah runs the program, and the Council on Foreign Relations in New York, where Amy now runs the program. This is a subject on which the 3 of us have interacted over a very long period of time. Amy and I have actually written, I think, more articles than I care to think about on this subject and related things, including the OPEC meeting, which is going to take place at the end of this month. Indeed, a couple of weeks from now, right after Thanksgiving, there's going to be a series of meetings in Vienna that are going to be capturing the attention of people who follow oil markets and geopolitics. On Monday of that week, on the 27th, there's going to be an expert meeting looking at non-OPEC oil production. These are people invited to sit with OPEC Secretariat members with expertise in subjects that are sometimes confusing but near and dear to the work of OPEC, including a deep dive into where Russian production might be going into the future. Then the day after that, the technical experts of the Joint Ministerial Monitoring Committee meeting are going to look at compliance and talk about steps forward, including how to bring an awful lot of oil back into the market without disrupting issues and prices, and then the ministers themselves on the 29th, then finally the ministerial meeting on the 30th. What we're going to do is we'll talk about OPEC as the occasion may warrant when we get into discussion, but really look at some of the background to what's happening geopolitically in the world, keeping with the theme of this conference, Riding the Energy Cycles. And I'd like to make some remarks about energy cycles and this cycle in particular as we kick things off. This last cycle has been particularly brutal and particularly disruptive. And it's probably as brutal as the one which was the setting for this organization's coming into existence, what happened namely in the 1970s when 2/3 of the productive oil resources of the world were nationalized by governments, largely the governments that comprised OPEC. When OPEC held sway over the cheapest oil reserves in the world and decided to turn the economics of this business upside down for good logical reasons, namely restraining the growth of the cheapest material to allow the higher cost material to be used first, getting a higher price than otherwise might be the case in a view of exploitation that was sort of like underlying peak oil supply theory. And then when the more expensive material would get exhausted, the lowest cost producers would be enabled to have a higher level of price with a higher level of volume. Clearly underlying that, it was the notion, also making economic sense, that the net present value of oil in the ground was significantly greater than the net present value of oil that was being produced. So that was kind of the overall setting in which most of us have been talking about the geopolitics of energy, talking about the use of oil as an instrument of foreign policy and domestic policy. And all of this was kind of a rational way of going about business if you were an oil producer from a low cost, high reserve area of the world. As the current cycle has unfolded, it seems to have triggered forces in my mind that make the worldview impossible to maintain, the old worldview of how oil markets worked, and has ushered in something very new. And before going into that, it doesn't mean necessarily, as I think Bob McNally is going to argue at lunchtime, that cyclicality is coming to an end. In fact, if you're in the commodity business one way or another, you know that it's illogical to make linear forecasts of where prices are going, because this is inherently a cyclical set of assets driven by investment cycles, leading from underinvestment to overinvestment, from overinvestment to underinvestment, as in the investor community moves in a sort of herd mentality, at least in terms of where the recent past has been and where the near-term future is going. So we don't think the cycles are going to be over by any stretch of the imagination. But I'd say generally, looking at the cycles in this business over the last 100 and now nearly 80 years since oil has been a commercially sold commodity, these cycles are regular. We don't know how long they're going to be. They can be very short, they can be very long, depending on how wars and depressions and other things interface with the investor community. And we know that they end up differently from the way they started. But I think this cycle in particular is going to be like cycles every once in a while, fairly dramatic and fairly impactful on the structure of markets, on the structure of the industry, and on the structure of geopolitics. that surround this industry. So what's really new when we try to come to grips with the changes that are occurring over this cycle? And a word about the beginning of the current cycle, which, and I know that we have multiple definitions of cyclicality, but I trace this to the last real bottom, not the bottom of 2015, 2016, when we saw prices going down to $30 a barrel that winter, but rather 1998, 1999. And I don't want to look at the causes so much as the supply background to that bottoming of prices in the winter of 1998-99. And one aspect of it in particular, which was that the world was not really investing a lot in finding new oil and gas resources. And the reason it wasn't was not only because prices were low, but because there was a generalized view, as per the Economist front page story in February of 1999, $5 oil for forever. And if there is $5 oil forever, why invest in new oil and new gas? Particularly when, in 1998, for OPEC countries in particular, Venezuela, Nigeria, Iran, and Iraq, had very credible investment plans to produce, among the four of them, 10 million barrels a day of oil, more than they were producing in 1998, in 2008. Credible because these were countries well endowed. Venezuela had just raised its capacity over a short 5-year period from 2.3 to 3.6 million barrels a day. Iraq was claiming an ability to produce 6 million barrels a day on a sub-3 million barrel a day base. Nigeria, then producing over 2 million barrels a day, was aiming credibly at over 4, given the delta resources, and in particular the offshore resources. And Iran, which had produced as much as 7 million barrels a day in the past, had also robust plans to grow. But what happened shortly into the next decade, the first decade of this century, was that those four countries in 2002-3 ended up producing half as much as they were producing in 1998, and that led to a scramble among everybody, whether it was Saudi Aramco or Exxon or others, to find new resources. A scramble that was unlike any other scramble in the history of this industry. And given where prices were running up, this was also yet again a period of resource nationalism, making it very difficult for companies to go into low-cost producing areas, but were incentivized to go into areas that were underexploited and that became commercial for the first time in history in a radically new way. And these were, of course, shale, but also oil sands in Canada and deep water, where, as our current century began, there were only 17 drilling vessels in the world capable of exploitation in deep water, and now we're moving toward 300. And the scramble for new resources obviously had cost inflationary impacts. Day rates for deep water vessels rose from $75,000 a day to $650,000 a day, indicative of the cost inflation across the sector. And the result of that scramble for new resources was really extraordinary, unexpected, and in the minds of some, even till today, not sustainable, which is where kind of the major debates in our sector originate. How stable is this growth in production, where we saw deep water shale and oil sands increasing production by 300,000 barrels a day collectively the year before the Libyan disruption took place in the early months of 2011. 2011 versus 2010 saw these three sources of supply increasing year on year, production by 600,000 barrels a day. By 2014, these three countries having these resources, Brazil, Canada, and the US alone, increased production by 2.3 million barrels a day. And by production, I mean crude oil, but I also mean natural gas liquids. So it was kind of a big, big deal by 2014. And I want to point to 2014 as what I think is the real turning point in the geopolitics of energy generally. I think it's as true of natural gas as it is of oil. In fact, in many ways more true of natural gas than it is of petroleum. But I'd like to think about a number of factors that are represented by colossal change in 2014. The first was the 2.3 million barrel a day increase by these three countries in the backdrop of the Libyan supply disruption of 2011. And you might say that what the energy sector has been dealing with since 2018 has really been the emerging failure of the petrostate and the emergence of the realization of the resource curse around the world, given that drop by 50% of production from four big OPEC countries between 1998 and 2002, 2003, a failure writ large by the time we get to 2011, when the Libyan supply disruption was just the first of many supply disruptions, adding 1.5, 1.6 million barrels a day to oil taken out of the market. By sometime in 2016, there was over 4 million barrels a day of oil that had been producing that was no longer producing. And yet in 2014, the production from these three countries, add Russia to it and you get a little bit more, overwhelmed the loss from the supply disruption and overwhelmed demand growth. That is really something new. A second factor that's unbelievably important is that this oil all came from the Western Hemisphere, and it was all fed into the Atlantic Basin, no Pacific Basin outlet. And that's critically important because between the time this organization was founded and 2014, the Atlantic Basin, like the Pacific Basin, and you might say like the Eurasian continent if you take it away from the Atlantic Basin, were all supply deficit areas. And starting in 2014, there was a permanent change for as far into the future as we can see, namely that the Atlantic Basin was no longer a permanent supply deficit area, but has become a permanent supply surplus area, which meant that the scramble among suppliers for new markets has been focused on the East Asian and South Asian markets, and that is also a kind of permanent structural change. A third factor in 2014, in January, at the beginning, first working day of the year, Dodd-Frank went into effect in the U.S. Since Dodd-Frank, there has been two critical factors in the financial side of the industry that has underlined price volatility that Bob McNally is going to talk about later, and undermine something that used to happen. Namely, we used to have a fairly reliable forward curve that fairly well reflected the cost of producing oil. And as we all know, the underlying factor in prices in a normally functioning world is what the cost structure is and what a cost curve looks like. And Dodd-Frank kind of undermined that until, and it will be undermined until something passes in regulation to allow something to substitute for that. And to give you some kind of basic numbers, between January 1, 2014 and January 1, 2017, overall open interest in traded oil on the NYMEX, CME, and ICE grew by 40%. And just to make things intriguingly more interesting, since January through last month, open interest mushroomed yet again by a sizable percentage of more than 15%. Meanwhile, anything in the deferred part of the curve, anything past 2018, lost liquidity because banks were no longer allowed to hold an inventory of derivatives believed to be too risky by U.S. regulators. And as a result of that, even with this mushrooming of open interest and liquidity, there was a decline in liquidity anything past 18 months. So if we want liquidity to give a good signal of mean reversion of prices, the market lost it in 2014. It has not recovered. It has made the forward curve more erratic and unrepresentative of anything, including investment risk, than at any time since the 1980s, when the forward curve first developed. A fourth factor in 2014, equally dramatic, was what happened when the United States and the European Union and some other countries imposed sanctions on Russian companies and the Russian government. at a time when one Russian company, Rosneft, had over $60 billion of short-term debt that had to be repaid to Western banks over a 3-month period of time, and the only place they could get credit after the retaking of Crimea was from China Inc. And China Inc. Came into the market very strongly by offering long-term pre-export finance to Russian companies, which meant in a market that was not growing as rapidly as the contracts for Russian crude bought forward, meant that there was a big seismic shift in the structure of imports into China and exports to China. And just to put a number on it, in August of 2013, Saudi Arabia was the largest supplier of crude to both China and to the United States. The U.S. was the number one customer. They were exporting 1.7 million barrels a day to the U.S., 1.2 and growing to China. And at one or another point in 2014, that market volume fell by 50%. 50% to China because of the Russian deal, 50% to the U.S. because WTI Brent spreads had widened and it was uneconomic at a $20 plus discount of WTI to Brent to sell oil into the market. So in 2014, we had 2 major speeches by major Russian officials telling us that the world, as we knew it was over, they were going to put more oil in the market, discounting to regain market share in the world. And this was indicative of, I think, where the world will be going at the end of this current episode within OPEC. A fifth factor, which was made even more critical the following year when the ban on oil exports was lifted in December 2015, was the U.S. started to become the energy hub of the world. And it's kind of amusing and ironic to think about China starting maybe the end of this year, maybe next year, a new oil contract to be settled in RMB and backed in gold, to kind of look at the real world since 2014 and the real world going forward, where while the U.S. may be seen as retreating geopolitically from the outside world, when it comes to the oil market, there has never been a hub quite like the U.S. Gulf Coast hub. The U.S. is the largest energy hub by far in the world, and it will become even bigger. And we can see that if we just kind of look at the net position of the U.S. in the last few weeks, where the U.S. has been an exporter net of over 4 million barrels a day of petroleum products, the largest exporter in the world of diesel, the largest exporter of natural gas liquids, NGL. LPGs exported out of the U.S. overtook Saudi Arabia as the largest one, and as the shale revolution was unfolding by 2014, another data point for that year, the U.S. became a larger exporter of LPGs than the entire Middle East combined. And pricing for LPG is undoubtedly the arb out of the United States to the rest of the world. When you are that big an exporter of crude now and also petroleum products, and an importer likewise of a sizable amount of crude oil and petroleum products, it is hard, if not impossible, politically to disrupt that market from that hub position. It's relatively hard to find a way to replace the U.S. dollar, which is currently responsible for 60%, 63 or 4% of all settled trade against the RMB, which is actually falling in terms of percentage of trade settlement and is in the single digits, below 5%. So that too is critical for geopolitics going forward. And then sixth, I'd just like to note, and Amy's going to talk about it more in a few minutes, the demand scene has changed dramatically. It's changed dramatically in terms of the percentage or the relationship, the elasticity of demand for oil products globally against GDP growth globally, as defined by that elasticity with respect to whether the growth is fixed asset investment derived or industrial production derived or consumer spending derived, but there is a significantly lower energy intensity to the world, not just in advanced economies, developed economies, but in emerging markets as well, and the slope is exactly the same in both emerging markets and advanced economies. There is, of course, something else going on. If we take a peek back over the last 5 years, beginning in 2011, going through 2016, demand for fuel oil has gone down. It's going to go down even more once the IMO 0.5% sulfur cap on marine gas oil is put in place on January 1st, 2020. But there has been negative demand growth for fuel oil. Most surprisingly, in a world where most of us who looked at demand growth 5 years ago thought that 55 to 60% of incremental demand growth was going to be diesel in emerging markets. And in the last 5 years, diesel demand growth in the world has gone down, hasn't gone up. All of the demand growth, basically, in the last 5 years has been from petrochemical feedstocks, gasoline, and jet fuel. And the irony, of course, here is that petchem feedstocks now come not from naphtha coming out of a refinery, but rather come out of natural gas liquids and the wet gas stream. So, if we think of a world of maybe 1.5 million barrels a day of oil demand growth, roughly a third of it is petchem feedstock that's natural gas derivative, not an oil derivative, feeding into a factor that you see looming large: jet fuel and gasoline. Most of the demand for oil is for transportation, not for industry, not for power gen, not for household heating, not for commercial space requirements, not for industry, but it's for transportation fuels. And that's very different from the world of oil before, when it was the be-all and end-all, cheapest way to get a fuel no matter what you wanted energy to be used for. So it's in this setting that we find that OPEC countries alone have discovered that they've been deprived of the marketing power they had when they turned economics upside down, so to speak, and kept oil in the ground in order to see a rising price in the future, where the net present value of oil in the future in the ground was higher than oil produced. And now that's been reversed to the degree that it can be when there are critical issues arising, like running out of cash, which was kind of the main driver of the rapprochement and bromance between the Russian government and the Saudi government in 2016. And yes, there's an overlay of politics involved, because the Saudis were seeing an existential threat in both the oil market and the neighborhood, and Russia seemed to be pretty critical about that. I'd suggest that whether we look at oil or natural gas into the future, we're looking at a world of three massive players. The U.S. is the most massive of them. In the oil market, if we think about who's the largest producer, the U.S. is by far the largest producer, and it will be a growing producer, outpacing the growth of the other two large ones, Russia and Saudi Arabia. If you look at the totality of crude oil, of natural gas liquids, of refinery efficiency gains, and biofuel use in the U.S. The U.S. today produces around 15.4 million barrels a day. And I think no matter what, it's likely to be producing 18 to 19 by the early years of the next decade, putting it in a very different league, nearly twice as big a supplier as either Russia or Saudi Arabia on its own. And unlike those two countries, which act for purpose with very large, if not monopoly companies, at least most favored companies for foreign policy purposes. And we have a U.S. sector without a large oil company, without being impolite, a bunch of cockroach companies that you can't kill off, that keep coming back, that keep having a lower and lower cost of production, and which has become the pricing hub of the world. Turn to natural gas and you find the same thing. By 2025, there will be three very large, lumpy suppliers of natural gas to global markets, each producing 100 million tons of LNG. Qatar clearly is almost there already. Russia and the U.S. The U.S. will be more than halfway to that mark. by 2020, when it should have the capacity to produce around 70 million tons, around what Qatar's current capacity is. And I suggest that that will make a big difference too. But I've spoken long enough with my introductory remarks. And I think the next two speakers will probably be almost as long, but